All right, let's dive into something fascinating, the high-stakes world of finance that literally builds the skylines around us. We're talking about those massive skyscrapers, the huge shopping centers, and how on earth these colossal projects actually get paid for.
I mean, it's a great question, right? It's not like one person just writes a giant check. The way these things are financed is almost as amazing as the buildings themselves. We're talking about a serious amount of money.
Try this on for size, $100 million. And for a big project, that's often just the starting line. So how do developers even begin to solve a 9-figure problem like that? Well, they don't find one source of money, they find many, and they stack them together in a really clever way.
And that brings us to this really cool concept, the capital stack. But honestly, a much better way to picture it is as a capital layer cake. It's an elegant structure that takes different types of money from different investors and arranges them into these carefully organized layers.
So here's the formal definition, but let's cut to the chase. The only two things you really need to remember are hierarchical structure and priority of payment. Put simply, it's a pecking order that dictates who gets their money back first. The investors at the foundation of the stack get paid first, which means they have the least amount of risk, and as you move up that stack, the risk just gets higher and higher.
So, let's do it. Let's build our $100 million skyscraper. We're going to assemble our capital stack, our layer cake, piece by piece, starting with the biggest and safest layer right at the bottom.
The very first layer, the absolute bedrock of this entire deal, is called senior debt. This is your classic big commercial mortgage that makes up the bulk of all the financing.
And you can see the relationship here crystal clear. Because senior debt is first in line to get repaid, it has the lowest risk. Lenders are practically guaranteed to get their money back. So because that risk is so low, the return they expect is also the lowest, usually in the low single digits.
For our project, that senior debt makes up a whopping $65 million. That's a huge piece of the puzzle, but it still leaves a $35 million hole. To fill that, we've got to move up the stack to the next layer.
And that next layer is mezzanine debt. The name literally suggests it's in the middle, and that's exactly what it is. It's riskier than that safe senior debt, but it's safer than the layers still to come. Okay, so you can see the pattern emerging, right? As we move up the stack, the risk goes up and so does the potential return. These mezzanine lenders, they only get paid after the senior lender is totally paid off. So for taking on that extra risk, you better believe they're going to demand a much higher interest rate. So let's add another $15 million to our stack. That brings our grand total to $80 million. We're getting closer, but we've still got a $20 million gap to fill.
This next layer is a pretty fascinating hybrid. It's called preferred equity. The best way to think of it is as a booster shot of capital. It's technically an equity investment, not a loan, but it often acts like one by offering a fixed rate of return.
At this level, we are now squarely in high-risk territory. These preferred equity investors only get paid after all the debt holders, both the senior and the mezzanine lenders, are paid back in full. So to make that risk worth their while, they expect an even higher return, often pushing well into the mid-teens.
With that, we add another $10 million to our stack. So let's see, we're now at $90 million total. We are so close. Just one final piece of the puzzle remains.
And here it is, the very top of our cake, the riskiest slice of them all, common equity. This is the money put up by the project sponsor or the developer themselves. This is their skin in the game.
Just look at that position, dead last. They are the absolute last ones to get paid. If the project loses money, their investment is the very first to get wiped out. But here's the incredible trade-off. If the project is a home run, after everyone else gets their fixed return, the common equity holders get to keep all the remaining profit. Their potential upside is literally unlimited. And that final $10 million from the sponsor does it. It completes our funding. We now have the full $100 million we need to build our skyscraper.
And here it is, our entire $100 million capital stack, all laid out. You start with that big, safe base of senior debt, and each layer on top gets a little bit smaller, a little bit riskier, and offers a higher potential return. It's a perfectly balanced structure of risk and reward.
Okay, so we've built the stack, but how does it all work in practice when the money actually starts rolling in? Well, that's all governed by a principle called the cash flow waterfall.
And it's the perfect name for it. Cash flows in at the very top and it cascades down,
filling each bucket one by one in order of priority. First, you've got to pay to keep the lights on, the operating expenses. Then you pay the senior debt lender. If there's money left, it flows down to the mezzanine lender, and so on, until finally, any profits that are left over pour into the hands of the common equity investors at the very bottom. Now, this might seem like just a bunch of finance jargon, but it has a massive direct impact on the world we live in. Without this really clever way of layering and distributing risk, many of the buildings that define our skylines, well, they simply wouldn't exist.
This quote really just says it all. The capital stack is the financial engine that allows developers and investors to take on these massive projects. It's a carefully negotiated balancing act that, when it works, creates value for everyone involved and literally shapes the cities we live in.
So the next time you look up and see a new building going up, you'll see more than just steel and glass. You'll see an invisible stack of capital, that layer cake of risk and reward, meticulously put together to turn a blueprint into a breathtaking reality. Thanks for tuning in.